40 million crypto exchange accounts, nearly a billion neobank accounts, nearly a billion brokerage accounts that all have access to some sort of Bitcoin derivative. ETFs, of course, continue to embrace Bitcoin. There's now been 125 ETFs with about $126 billion of capital. The capital flowing into these ETFs continues to accelerate. And as you can see, we were the first company to embrace Bitcoin, and now we're up to 194 public companies. We anticipate this will continue to grow. Lots and lots of IPOs. The public markets have embraced Bitcoin, and this is just an example of some of the notable companies that have come public just recently that have substantial Bitcoin exposure. The digital credit ecosystem has been a very pleasant surprise. It has grown very rapidly and has become very diverse. And the way that we know that digital credit is working is that companies and economic actors everywhere in the world that we've never met face to face are discovering this, and they're building products and businesses around it. So right now, what we see is very enthusiastic support with retail investors, with corporate treasurers, with institutional investors, with crypto native innovators, and with TradFi innovators. So 5 different groups of capitalists, but they're all getting very heavily involved enthusiastically and rapidly. If we drill into retail, 80% of all STRC shares is held by retail as of our last check. This is an extraordinary fact. Normally, it's very difficult to get broad, deep retail support for a common stock or a public stock, and yet we've been very pleasantly surprised. We're able to trace about 120,000 individual retail accounts. Word of mouth is spreading this. It's spreading virally. Based upon our studies, we see that anybody that buys STRC is generally telling their friends, their family, their parents, their working associates about it, and it continues to spread word of mouth. You can also see Schwab is a big distribution channel. 23% of Stretch is held in Schwab accounts. Fidelity is a channel. Robinhood is a channel. Morgan Stanley and E-Trade channels. BlackRock is a channel. Interestingly enough, Vanguard, that won't let their investors buy Bitcoin natively, they actually are a channel for Stretch. And so it's pretty exciting that we have wrapped Bitcoin into a credit instrument that is being distributed through all sorts of traditional finance channels to types of investors that otherwise would never be able to buy Bitcoin itself or would never want to. We actually have traced Stretch exposure, and we estimate that there are about 3 million households that are benefiting from Stretch right now. So think of it as powering a savings account for 3 million households. Fong mentioned about 100 million beneficiaries of MSTR. Well, 3 million beneficiaries of STRC in 8 months is a pretty good start to the race. Our ambition is to spread this to tens of millions and then hundreds of millions of people. So we're off to a good start, but we're just very enthusiastic about the retail support. We're also very enthusiastic about corporate support. Corporations, unprompted by us, we didn't go and sell this to them. They just figured out that it was a good idea for them. But corporate treasurers and corporate CFOs with working capital have been allocating some of their treasury capital to Stretch. And this is a really pleasant development. And, we're starting to think that there might be thousands of companies that might allocate some amount of their treasury capital to Stretch. And, I've had a lot of experience selling BTC to corporations. What I found is that tends to be a board level decision. It goes all the way to the board of directors. The CEO has to be way behind it. And if one director on the board has concerns, the cycle slows down. But with STRC, it's not a board level decision. It's more like a CFO level decision. If the treasurer is enthusiastic, the CFO can green light it. They might or might not give the CEO a heads up. But this is a very different value proposition. It's maybe a 5-minute conversation with the CEO instead of a 2-hour conversation with the entire board. For that reason, we think that STRC really is Bitcoin for corporations. It's going to spread very rapidly now. The other thing that's very exciting is that STRC has spread into credit indexes. BlackRock's PFF is a $14 billion credit ETF and stretches the number 2 holding. VanEck's PFXF is another credit ETF, and Strategies stretches also the number 2 holding. And so imagine an instrument coming out of the blue, didn't exist 12 months ago, and in less than 12 months, we've gone from non-existent to number 2. Next stop, number 1. We're enthusiastic about seeing stretch embedded in lots and lots of institutional credit indexes and lots of institutional credit funds. Third-party ETFs have been finding stretch, and they're building innovative ETFs. Strive is building a digital credit ETF. 21 shares created an ETF with stretch and took it public in Europe. There's a number of ETF providers that are working with us that are in the pipeline right now. I think active discussions with 4 right now. And so we would think that over time there'll be more ETFs that build STRC into their fund offering. So here I'd like to talk about digital money and digital yield. We start with digital capital. Bitcoin is 34 vol on a rolling 30-day average. It's 39 ARR. The 1-year trailing vol of Bitcoin is almost 40. So think of it as a 40 vol, 40 ARR asset, raw economic energy. We split that asset into STRC, which is 3 vol, 11.5% yield, and then MSTR, which is 71 vol, 59% ARR. So one's an amplified Bitcoin we call digital equity, and the other one is damped, digital credit. Now, digital credit, we believe, is like the kerosene of finance, right? It is the monetary fuel, and is a universal monetary fuel. It's high grade, highly distilled, but from here you can build all manner of products. And we see the layer 3 as digital money and digital yield. And neither of them would really be possible without digital credit. It's just too difficult to distill pure 0 vol 8% money from a 40 vol 40 AR asset. You have to crack it. You have to have a crypto reactor, and you have to have billions of dollars of equity capital to do it, and that's what we did to create Stretch. So, simple definition, digital money in our lexicon is 0% volatility, daily liquid instruments built on digital credit, like 0 vol 8% yield coin. And then digital yield, that's non-zero volatility, or it might be illiquid. It might be a 3-month lockup, 5x levered, 35% yielding fund that loops digital money 4, 5, 6 times in order to get there. And so digital yield is a levered construct, and digital money is the stripped down construct. We think digital credit's programmable across lots of dimensions. So there are a lot of ways to add value to it. You can tokenize it, put it in a private fund, put it in a public fund, put it in a bank account. You can deploy it on a crypto exchange, on a neobank. You can deploy it on a real bank. You can deploy it on a crypto network. You can program it to have volatility of 0 or let it float up to a volatility of 10. You could program the liquidity to be continuous or daily or monthly, but you could also put in a quarterly lockup or an annual lockup in order to put more leverage on it or create a different characteristic. You can program the yield from 5% up to 25% reasonably. Some people might go beyond that, but we think 5 to 25 is reasonable. And then you can convert the currency. You can create Great British pounds or euros or yen or Swiss francs with digital credit starting from STRC. And so when you think about all these different forms, the question is, do you want to create a yield coin, like a digital money coin? Do you want to create a yield fund? Do you want to create an account? Right? And depending upon what your assets are, if you're the biggest bank in Australia or if you're a Deutsche Bank, you probably would do it one way, but if you're a crypto exchange, you might do it a different way. The math is pretty straightforward. You start with 11.5% performance and like 3 vol right now. If we're lucky, maybe we'll be able to get our vol to 2 or to a 1 handle. I mean, that's the goal of our proposal to the shareholders. But I doubt seriously we get below a 1.5 or a 1 vol. 1 vol is sort of what publicly traded money market funds look like right now. But getting to 0 vol takes a bit of work. So one approach to add value is to step it down, strip the vol to 0, and maybe instead of 3 vol 11%, you offer 0 vol 8%, and that's digital money. And the other approach is step it up, right? Lever it 3 to 1, pay 5% for the capital, and maybe you end up with something that's paying you like $35. You pay $10 on the capital, and you get a 25% yielding levered yield fund, and these are all opportunities. Where we are not going to do it ourselves. Our laser-like focus is make Stretch the deepest, most liquid, most stable, least volatile, highest Sharpe ratio credit instrument in the world, and that's a mission. But what we think is there are a lot of crypto innovators, and you see right here on this screen a lot of very impressive companies, that are moving fast right now. Apex has had enormous success early on. Saturn's doing the same thing, but Hermetica, Kraken, Roxum, Ondo, Pendle, Spread, Strata, they're all doing very interesting things right now, and they're very innovative, and they're moving about 10x faster than the TradFi complex normally moves on these sort of initiatives. But having said it, there's a lot of interesting TradFi initiatives, things you can do in a traditional finance environment, either with a private fund or a public fund, and we see those things happening as well. 8 weeks ago, there was no Stretch in the DeFi industry. And in those 8 weeks, we have rapidly grown to something like $270 million of exposure. So this is just really extraordinary, the rate at which money is flowing. Sometimes money is flowing into this complex $1 million an hour, $2 million an hour. It's starting to feel to me like we may very well see more than $1 billion of Stretch enter the DeFi industry in the near future. It's moving very fast and it's very dynamic. So let's speak about outlook and our vision. We're a structured finance company, and you can see here we're taking raw capital, digital capital, 40 vol, 40 ARR, $1.6 trillion market cap of Bitcoin. We are stripping the currency risk. We are reducing the credit risk. We are compressing the duration risk. We are distilling a yield. We are damping a volatility in order to create various instruments. And our greatest product and biggest success right now is Stretch. As you can see, it's taking a 71 vol down to a 3 vol. We're targeting a 1 vol. Some important items to be aware. The Bitcoin break-even ARR, we calculate it all the time. It's very significant for this reason. If Bitcoin grows more than 2.3% a year, that break-even ARR, we can fund our dividends forever. We can fund our dividends forever without selling a single share of stock. It is a very critical point. If Bitcoin does not grow at all forever, we can fund the dividends for 43 years. We're very clear about this. You'll see we publish it on our website, and we update it every 15 seconds. So let's go to the next slide. Here you see, this is our website. If you go to the credit tab, you're going to see we show you the Bitcoin reserve. We show you the years of dividends. That's the years we have of coverage of Bitcoin appreciates 0% a year. And then we show you the Bitcoin break-even ARR, 2.27%. It's updated every 15 seconds. So for those people that are wondering, what is the credit risk in all of these instruments? I encourage you to go to the credit tab. You can go and you can type in, you can assume the Bitcoin price crashes to 30,000. You can change your vol outlook. You can change your AR outlook. The model will recalculate all of the risk and credit spreads for every credit instrument and especially for STRC. And as I said, we're updating all of these things in real time every 15 seconds. There's a misnomer. Sometimes people think, well, Bitcoin has to appreciate 11% or 11.5% for us to be successful or cover the dividend. Not true. 2.3%. Or they think 30%. No, that's what we think it'll do. The number that really matters is 2.27%, the big BTC break-even ARR. Now, it's important for another reason. The BTC break-even ARR is also the inflection point where stretch issuance results in more Bitcoin being stacked by our company than the Bitcoin we use to pay dividends, if we choose to pay dividends with Bitcoin. So this chart here, what it illustrates is that we don't have to sell a single share of stock. We could stop selling MSTR common stock right now. We can fund the dividends with Bitcoin sales. And if stretch issuance is greater than that BTC break-even number, not only will we fund the dividends forever, we will increase the amount of Bitcoin that we hold forever at the same time. So you would say, well, how much is that? Well, you can see if we were to sell $1.5 billion of stretch per year, we can sell Bitcoin, pay the dividends, buy more Bitcoin than we sell, grow our Bitcoin stack, and generate Bitcoin yield. Now, of course, we sold $1.5 billion of Bitcoin in 1.5 billion in stretch in 2 days a few weeks ago. So yeah, I think we can definitely stay above that break-even point. What you see here on this slide is that if we actually have stretch issuance equal to 20%, that would equate to $12.8 billion of stretch sales this year. And we're kind of on the path to that if we look at the first 4 months of performance. We might exceed it, who knows, we might be less. But if we actually run at a 20% issuance rate, then the first order model shows or indicates that we generate a BTC yield of 17.7%. We accumulate an additional 144,000 Bitcoin, and that's after we pay all the dividends by selling Bitcoin. So again, the most important point here is there are occasionally some short narratives. People would say things like, well,